In Module 3, we'll be talking about candlesticks and chart patterns. And to kick this off, we're going to begin with how chart patterns work. There's often a basic debate in the financial community around fundamental analysis and technical analysis and chart patterns, and which is the best way to predict future stock price. I like to run through 4 different reasons why technical analysis works and can and should be used in conjunction with fundamental analysis. First, fundamental analysis does not account for people. People are emotionally and psychologically driven, and people trade markets. Even fundamental analysis can be interpreted in different ways by different people. During the dot-com boom, one of the fundamental analysis tools popular at the time was burn rate. Burn rate was the amount of money a company was burning through in order to execute its business plan. The vast majority of the dot-com companies were unprofitable at the time, but the higher your burn rate, the more highly valued your stock was. It was a bizarrely backward use of fundamental analysis, but people bought into the argument that the faster you burn through cash, the better off your company was. As long as people trade markets and don't base all of their decisions on fundamental analysis, technical analysis will have a place. Second, chart patterns and technical analysis allow a trader to impose discipline on their trading. By using chart patterns and technical analysis, a trader can clearly define entry and exit points, stop loss points, and a variety of other important trade management tools which are not available through fundamental analysis. By using chart patterns, which are based on historical price movement of a stock, a trader can more easily manage a trade and ensure the most likely profitable outcome given the information available. Third, technical indicators impact the market because traders use them when trading the market. This is especially true in certain markets, such as Forex or the trading of cryptocurrencies, as the main group of traders in these markets are very technically driven. If a large number of traders are using technical analysis to place trades to buy or sell, then those traders end up setting support, resistance, entry, and exit points that are clearly marked through chart patterns and technical analysis. Finally, number 4, random walk theory states that a previous day's price does not matter for the price today. But the problem with the theory is, again, that people trade markets, and traders are always looking at previous prices to try to predict where a stock or market is going to go in the future. Traders look at previous price action to make decisions, and therefore previous price action definitely has a bearing on how a market or a stock is traded. All of these factors together combine to make technical analysis a valuable tool, and with it, chart patterns, which are often psychologically based patterns, can give the trader an edge in managing their trading portfolio. Throughout this module on candlestick patterns and chart patterns, we'll be talking about specific patterns and how those patterns can give you an edge in your trading and portfolio management. I look forward to seeing you in the next video. Welcome back to our second lecture in Module 3 on wedges, triangles, and pennants. 3 patterns that are similar. Sometimes they are continuation patterns and sometimes reversal patterns. So wedges, triangles, and pennants are patterns in which a stock price is being compressed. A wedge is a reversal pattern. A rising wedge has higher highs and higher lows and is bearish. A falling wedge has lower highs and lower lows and is bullish. A triangle pattern can be either bullish or bearish. A symmetrical triangle is neutral in that the direction of the break is not determined until the stock moves in the particular direction out of the triangle in which the trader would want to trade. An ascending triangle is bullish, has higher lows and flat highs. A descending triangle has lower highs and flat lows and is bearish. And in each of the triangle patterns, we're looking for a break out of the triangle to give us the direction to trade. Finally, a pennant is a price compression continuation pattern following a sharp rise in price. This is often also called a flag pattern, and the sharp rise in price is called the flagpole. Now let's look at a couple of charts to give a few examples of these patterns. Here we have a daily chart of Bank of America. And here we have a falling wedge. As you can see, the stock is making lower highs and lower lows. And when the stock breaks above this falling wedge pattern, it moves to the upside. So again, a falling wedge is a bullish pattern. When the stock breaks above the upper bound of the wedge, that is a buy signal. Here on a daily chart of Raytheon, we have an ascending triangle. We have resistance level here. You see we're making higher lows. And then when the stock breaks through the upper level of the ascending triangle, you get a sharp move to the upside. Now let's take a look at a daily chart of Hertz. You'll see the stock has been trending down, and they'll get a sharp upturn in price. And then we have a pennant pattern. We have a couple of days of the stock trading sideways to slightly down. And then when it breaks the pennant pattern, it continues back to the upside again. Let's look at one more pennant pattern in lumber liquidators. As you can see, we have a very sharp rise in price. And then the stock trends down in this short pennant pattern. And as it breaks the pattern, it breaks back up to the upside again. So the pennant pattern is a continuation pattern. This is the flagpole, as this is also called a flag. So the rise in price is the flagpole. And the continuation is to the upside as it breaks above the upper bound of the pennant or flag. Finally, let's look at a descending triangle in Dollar Tree. We're looking at a daily chart, and we see a support level here at around $48. And then we see the descending triangle pattern. And as the stock breaks through the support level, we see this bearish pattern take place. So each time the stock moves up in this triangle, you get little up moves, but it gets lower and lower. So the buyers here are getting more worried. And finally, when the stock breaks through, you get a quick move to the downside. And that's the descending triangle pattern. So that's a couple of examples of triangles, wedges, and pennants, and what those continuation and reversal patterns look like. In our next video, we're going to talk about double tops and double bottoms and how to trade these patterns. I look forward to seeing you in the next video. Welcome you back to our third video in the Candlesticks and Chart Patterns Module 3. Today we'll be talking about double tops and double bottoms, what that chart pattern is, how to trade it, how to look for the potential profit in that pattern, and where to set your stop. So let's get to trading double tops and double bottoms. Double tops and double bottoms are both trend reversal patterns. So you'll have a stock trending in one direction, and when you recognize the double top or double bottom, then the stock is most likely headed in the other direction, at least for a short time. In a double top, the stock touches a new high, reverses to a lower level, touches the high a second time, and then falls below the pullback low. In a double bottom, the stock touches a low, reverses to a higher level, touches the low a second time, and then rises above the pullback high. So a double bottom is a reversal of a stock in a bearish pattern. A double top is a reversal of a stock in a bullish pattern. Basically, the pattern that you're going to look for in the double bottom looks like a W, and in a double top, it looks like an inverted W. The price target we're looking for in this trade is generally the difference between the high and the pullback price or the low and the pullback price. So let's say you have a stock trading at 17. The stock moves up to 20. It moves back to 17, back up to 20, and then back down through 17. The difference between 20 and 17 is 3. So you're looking for a $3 price target in that stock. So you're looking for it to fall to around $14 before you would cover a short position in the stock. Generally, the risk-reward ratio in this pattern is relatively low if you use the high or the low as your stop. So what I would recommend is using a trailing stop in this situation. You can begin by using the high or the low as your stop, but then I would move my stop in a trailing fashion as the stock moves in the direction that's profitable for your trade. Now let's look at a couple of charts for an example of a double top and a double bottom. First, we're going to look at a double bottom in the chart of Thor Industries on a daily basis. Here we have Thor trending down from December 2015. The stock moves down, touches just above $48, moves back up to just around $53, and then moves back down to that $47.5 to $48 range. The price in the double bottom as well as the double top does not have to be exact. It doesn't have to touch the exact same price, but you want it pretty close. In a stock like this, a $50 to $60 stock, you'd like it within, say, 50 cents to a dollar at the most. So when the stock has a pullback to the $53 range, you're going to take the difference between the $53 and $48. So we'd be looking for a $5 profit after buying the stock when it breaks through the reaction pullback high at this point. So this is your buy level. When the stock breaks above 53, you're looking to get long the stock. And again, you're looking for a $5 price target, which obviously was achieved in Thor in this situation. And that is the double bottom reversal pattern. So now let's take a look at First Financial Northwest. This is a classic double top pattern. The stock is in a fairly long-term bullish pattern. It hits a high at $21, pulls back to around $19.75, pulls back up to $21, and then breaks that $19.75 level. And as you can see, you've had a long-term pattern here, and this double top indicates a bearish reversal, and it's a fairly hard fall from the top. So this is a great example of a double top, again, in a longer-term bullish pattern, and how powerful the double top pattern can be. Thank you for joining me for this video on double tops and double bottoms. In our next video, we'll talk about the head and shoulders pattern and the cup and handle pattern. Thank you for joining us, and I look forward to seeing you in the next video, technical analysis video. Today, we are going to be talking about the head and shoulders pattern and the cup and handle pattern. So let's jump right into these two patterns. The head and shoulders pattern is a bearish reversal pattern. You'll see the head and shoulders pattern at the top of a bullish trend. The pattern is represented by a formation that looks like a head and shoulders on the chart. The story behind the pattern is that a stock is trending up. It is making another push to the upside. Bearish sellers then push the stock back from a high. This is followed by bullish buyers who are able to push the stock up again past this initial shoulder on the left-hand side. So you reach an even higher high, which represents the picture of the head in the pattern. Bearish investors are then able to either sell the stock or short the stock back down to what is called the neckline. Bullish investors make one more final push to the upside, but not quite reaching the head of the pattern, which results in a second shoulder in the pattern. This can also result in frustrated buyers who have bought at the top or the head of the pattern. Subsequently, the stock breaks the neckline, heading lower, and that's the point to either sell your long stock or to get short. Next, let's talk about the cup and handle pattern. A cup and handle pattern is a combination of a consolidation pattern, which looks like a cup. You'll have the stock starting on the left-hand side of the pattern, trending down in a shallow pattern, and then trending back up. Again, looking like a cup or the letter C lying on its side. You'll get a pullback on the right-hand side of the pattern, which looks like a handle. And then when the handle portion of the pattern starts to move up, that's the buy signal. The handle portion is similar to a pennant pattern or flag pattern that we talked about previously. So let's take a look at a few charts of these patterns. Let's start by taking a look at the head and shoulders pattern in the stock of CubeSmart on a daily basis. So here we have the stock in a bullish trend. The stock pushes to a new high here on November 17th. There's a subsequent pullback around December 6th and 7th. And it's okay if it's not one single day that you see the pullback in. It can be arranged like this. We see a new high being set in the December 18th, 19th time frame. This is the head. You got the first shoulder, the head at a new high. Another pullback to the neckline. That's what this trend line represents, is the neckline. A push back up, but you can see it doesn't reach as high as the head. So this is your second shoulder here. And then a subsequent break to the downside. When it breaks this neckline, that's the point where you want to be short the stock. So that's the head and shoulders pattern. Now let's take a look at the cup and handle pattern in the chart of Target. We're looking at this on a daily basis. You see how I've drawn the curve. This is the cup. Now the cup pattern doesn't have to adhere strictly to the curve. But as you can see, we've got a shallow pattern. The stock had trended up. It was in a positive bullish trend. It trended up to around $60. You get a pullback. Stock comes back to around $45 at its low. Comes back up to right around $60. And then you have a slight pullback that looks a little bit like a pennant. And this is the handle of your cup. And when the stock price moves above the handle that's sloping down, that's your breakout to the upside. And that's your buy point. As you can see, we had a very nice move up in the stock from that 60 level up to around $72 before we reversed again. So that's the cup and handle pattern. Thank you for watching this video on the cup and handle pattern and the head and shoulders pattern. In our next video, we are going to be talking about single candlestick patterns, and we'll really start to get into candlestick patterns over the next 3 videos. Thanks again, and I'll see you in the next video. Welcome back. In this video, we will be talking about single candlestick patterns. Before we jump into the candlestick patterns we'll be discussing today, I do want to point out that the candlestick patterns, even though they're single candlesticks, they're always part of a pattern. We'll be talking about a couple of different candlestick patterns today, but remember that each time we look at the single candlestick pattern, it's still part of a pattern. One of the downsides of candlestick charting is that people who are new to it often see patterns where there aren't patterns. So take your time and make sure that each of the requirements are met to identify a pattern as we go through these single candlestick patterns today. So now let's get into it. The single candlestick patterns we're going to discuss today are all trend reversal candlesticks. The first one is the spinning top. It has a long, equal length shadow on each side and a small body. The doji candlestick has a small body, meaning the opening and closing prices are very close to each other. So the body is almost a line, a horizontal line by itself, and then either 2 long shadows or 1 long shadow. And then the hammer is a bullish reversal candlestick that reverses a prior bear trend. And if the candlestick were to appear at the top of a bull trend, the same candlestick would be called a hanging man and would reverse a bull trend. We're talking about the hammer that reverses a bear trend. It has a small body with a short to no shadow on top and a long shadow on the bottom. Both the spinning top and the doji represent indecision in the market. So if we're talking about a bullish pattern, then the stock has moved up. It has gotten to a price level where there are a fairly equal amount of buyers and sellers, and there's indecision as to which way the stock will move at that point. In each of these patterns, we'll be looking for confirmation before we trade. And in my example, if we're looking at a bullish pattern and we see a spinning top, that doesn't mean the next day we're going to go short the stock. You'll see the spinning top, and then you'll need to look for confirmation that the stock is topping and heading lower before entering the trade. And it'll be that way with each of the patterns we talk about. It's important to have confirmation, meaning the stock is starting to move in the direction you think it will before entering any trade. So now let's look at a couple of chart examples of each of these. The first chart we're going to look at is a chart of Target on a daily basis. Here we see the stock in a downtrend. And then we get to, on February 5th, a hammer. So we have a small body, almost no shadow on top, and then a long body underneath. The next day, we get a reversal in price, and the stock starts to move up. It is at this point, on the next day, or possibly the second day after the hammer, that you would place a buy order in the stock, with the hammer being your stop. The hammer shows that the bears were in control, drove the price down to a low of 54.66, but then couldn't hold the stock down any longer. As we can see in this pattern, the hammer held, and there was a very nice move to the upside in Target. If we had been trading the stock at this level on January 27th, this also may have looked like a hammer or another candlestick pattern that would indicate that the bearish trend had run its course. But you'll see over the next 2 days, this did not confirm, and the stock trended down. That's an example of what I'm talking about, and that you need to have both the candlestick in particular that we're looking for, in this case the hammer, as well as confirmation the next few days after seeing this single candlestick. Now let's look at an hourly chart of Johnson & Johnson. We have the stock and a solid uptrend when we get a spinning top and then another spinning top at the top of the trend. This is followed by a bearish candlestick and then a second, following a third bearish candlestick. So here we have a cluster of candlesticks, all representing a bearish top. But the first one that gets us interested in the stock here for a shorting opportunity is this doji at 1530. We're looking at an hourly chart here. This is October 23rd at 1530. So this first doji draws our attention, and then we see a confirmation as the stock starts to drop down with the next 3 to 4 candlesticks. The stock continued down. It would have been a very good short trade as the stock continued down to 139 from 144 on an hourly basis. So that's a doji or spinning top reversal. I'm almost using the terms interchangeably. As we can see, it's a very small body, which indicates there's price indecision at this point. Now, whether this is a spinning top or a doji is irrelevant in that we know the small price point represents indecision. Let's look at one last chart of eBay. The stock is in a bullish pattern. This is a daily chart. And then on July 20th, we get a clear doji. Look at the long shadows and the very slim horizontal line. So the opening and closing price, which we can see in the upper left, the stock opened at 37.17 and closed at 37.18. So literally there's a 1 penny difference in the opening and closing price after the stock had traded up to as high as 37.48 and a low of $37. So this would definitely have gotten our attention as a possible shorting opportunity. And then we look at the next day, the stock's down, and the next 2 candlesticks we have a down pattern. If we had shorted the stock at this point, we would likely set our stop at 37.17, the price and decision point for the doji, and we would have made a nice short gain as the stock traded from $37 down to $34 here on August 21st. So that's the Japanese candlestick and doji reversal pattern. Thank you for joining me to talk about single candlestick patterns. In our next video, we'll be talking about double candlestick patterns. I look forward to seeing you there. Thanks. On this technical analysis video about double candlestick patterns. The double candlestick patterns we'll be talking about today require 2 candlesticks and the confirmation of the pattern. The bullish engulfing pattern and bearish engulfing pattern are both trend reversal patterns. Each features 1 candlestick in the direction of the trend and a second candlestick which is larger than the first in the opposite direction of the trend. So if we have a bullish trend, we'll have a bullish candlestick, usually with a long body, and then the second candlestick will be a bearish candlestick with a longer body than the first candlestick that encompasses or engulfs the body of the first bullish candlestick. And the same is true for a bearish trend in the opposite direction. Tweezer tops and bottoms are reversal patterns as well, and they feature 2 candlesticks with shadows that are equal to the same price, either the high or the low. So if you have a stock trading in a bullish trend and it trades up and touches $50, but pulls back and finishes at $49, and then the next day it trades back up to $50 and pulls back and finishes at $49.50, you'll end up with a tweezer top at that point, because each of the 2 days the stock has gone up and touched 50 but hasn't been able to hold. An important thing to remember as we go through these candlestick patterns is that while they have interesting names, it's more important to realize what's behind each of the patterns and why the stock is behaving as it does after the pattern occurs. Most of these reversal patterns feature a stock is moved to a certain price and then can't hold that price, either a high or a low, meaning the bullish investors can't keep the stock at a high price because there are more sellers coming in, or bearish investors can't keep the stock at a low price because there are buyers coming in. Now let's look at a couple of charts as an example. First, let's start with a bullish chart of Google. This is the daily chart. We have the stock moving up. We have a large red candlestick here, which puts a little bit of a dent in the bullish trend. But we see a pullback and the stock starts moving up again. So it's just a continuation of this bullish pattern. And then we have the bearish engulfing pattern. So here's what the pattern looks like. We have a single candlestick that's bullish on January 23rd. And then the next day, which is the 26th, this candlestick develops, and you can see it's both longer on the upside and longer on the downside than the candlestick from the day before. And after this bullish engulfing pattern, we see a slight sell-off in the stock of Google or Alphabet. And then the stock rallies again. But this is a pretty clear bearish engulfing pattern. There's no ambiguity that this candlestick is larger and encompasses the entire size of the candlestick before it. Let's take a look at this bullish engulfing pattern for Netflix. We have a bearish trend. We're on an hourly chart here. We have a large red candlestick, and it looks like the stock may continue this downward trend. And then the next day we have this bullish candlestick that's a bullish engulfing candlestick. The bottom is lower than the close from the day before. And the top of this candlestick, the close of this candlestick, is higher than the open from the day before. So you have a bullish engulfing pattern here. And as we see, the stock trended up nicely after this very clear bullish engulfing pattern. Finally, let's look at this tweezer bottom in the stock of Yelp. Again, we're on an hourly basis. We have the stock trending down from just above the $40 level to the $38.20 level. And then we have the first candlestick in this pattern is a negative candlestick, continuing the pattern. The second candlestick is a bullish candlestick. And as you'll note, the price, the low is $38.11 and the low is $38.11. So they went to the exact same price. And again, as I was stating earlier, the reason that this reversal pattern works is because on this day, they couldn't get through this price level at 38.11 and the stock rallied. And then on this day, the same thing happened. The stock went down, traded at that level, and then bounced off. So 2 days in a row, it bounced off the same price. It finished higher on the second day, and then the stock went into a bullish pattern. So that's a tweezer reversal. Thank you for watching this video on double candlestick patterns. And our next video, and the last video in this series, we'll be talking about triple candlestick patterns. Hope to see you there. Welcome you to the final video of this module and the final instructional video of the course. If you've been through the whole course, I'd like to thank you for sticking with me this whole time. This final video is going to be on triple candlestick patterns and how to trade them and profit from them. We're going to talk about the morning star and the evening star, which are triple candlestick reversal patterns. The morning star pattern, the stock is in a bearish downtrend. The first star of the pattern is a bearish long body candlestick, followed by a doji, which can finish in price either below or above the bearish long body, and then a bullish long body candlestick that closes at least halfway into the price of the bearish candlestick. That's halfway into the body of the bearish candlestick. The evening star, which takes place in a bullish trend, is exactly the opposite. The other chart pattern that we're going to talk about with the triple candlestick is either 3 black crows or 3 white soldiers. Standard candlesticks often have a black body for a down day and can have a hollow or white body for an up day. So a black body candlestick is a bearish candlestick, and a white body candlestick is generally a bullish candlestick. In this reversal pattern, the black crows or 3 down days would represent a reversal in a bullish pattern, and the 3 white soldiers would represent a reversal in a bearish pattern. The first candlestick is a relatively long body. The second candlestick should have a longer body than the first, and then the third candlestick should have at least as long of a body as the second candlestick. Again, both of these are reversal patterns. Let's look at a few examples. The first pattern we're going to look at is a short-term evening star pattern on the hourly chart of Rider system. So here we have a bullish pattern as the stock moves into the 70s on the hourly chart. We have the first candlestick being a bullish candlestick, which continues the bullish pattern. The second candlestick is a doji. This is our star. And then the third candlestick of the pattern, this candlestick has to extend at least into half of the body, and it extends further than that into the body of the first bullish candlestick. And then we get a reversal in trend on the hourly chart, and the stock trades down. So that's the evening star. I'd like to point out something else on this same chart. If you look a couple of hours later, we have what's very close to a morning star. And we're going to talk just a second about being caught up in the exact terminology of the candlestick. Here we have a bearish candlestick in a bearish pattern. Here we have not quite a doji because it has a little bit larger body than a doji. But if you understand what's behind the pattern, then it represents the same thing. The price held at a low and then rallied. And then we have the bullish candlestick. So in essence, we have a morning star pattern, even though it's not by the strictest definition a doji. And then the stock rallies. Finally, let's look at a chart of McDonald's to find the 3 white soldiers pattern. We have a bearish trend. The stock drops hard. Then we have a long body followed by a longer body. And then the third body approximately as long as the second body. It can be longer, and that's okay. But here we have 3 successive days of an uptrend after a relatively long downtrend. And we're looking at an hourly chart here. As you can see, after the 3 white soldiers pattern, the stock trades sideways for a few hours and then steadily increases. So that's the 3 white soldiers reversal pattern. I'd like to thank you for joining me in this final video where we looked at triple candlestick patterns. And I'd like to thank you for joining me for the course. I hope you enjoyed the videos as much as I've enjoyed making them. Thank you again.